Good morning. You are watching live daily market outlook for Monday, 12th of March 2012, prepared by Windsor Brokers. The markets are in the consolidative mode during the Asian session and early hours of European session after sharp moves caused by more positive and better than expected the U.S. jobs data last Friday that pushed the dollar significantly higher, and their counterparts, euro and sterling, to their lows, while the dollar continues to appreciate against dollar yen and dollar Swiss. The U.S. employers, as mentioned on Friday, added more than 200 jobs to their payrolls for a third straight month in February, a sign that the economy was strengthening and in less need of further monetary stimulus from the Federal Reserve. The Friday's Labor Department report, which showed the non-farm payrolls increased by 227,000 new jobs last month, also bolstered President Barack Obama's chances for re-election. The jobless rate held at a three-year low of 8.3%. Even as people flooded back into the labor force to hunt the work, and 61,000 more jobs were created in December and January than previously thought. The stocks on Wall Street closed higher on the data, while Treasury debt prices dipped as traders dialed down the prospects for more bond buying by U.S. Central Bank. During the Asian session, the Asian shares fell as investors paused to assess the effect of strong U.S. jobs data, which scaled back expectations of more easing ahead of this week's Federal Reserve meeting, while uncertainty over Chinese growth also weighed on sentiment. Just to mention that Asia Pacific ex-Japan, the main index MSCI eased 0.8% after rising as much as 1.3% on last Friday. The index has risen about 12% this year. The Japan's Nikkei average index erased earlier gains and fell 0.2% during the overnight session, retreating from a fresh 7-month high reached earlier. The Nikkei is up about 18% this year. The US dollar hovered around 3-week highs against a basket of major currencies and held close to Friday's near 11-month high at 82.64 yen. The euro eased down to 1.3080 zone after hitting its lowest level in about a month during the Asian session. As Greece averted the immediate threat of an uncontrolled default when a sufficient number of private creditors agreed on a bond swap deal last Friday, that will cut the country's public debt and clear the way for a new bailout. Concerns about Europe's debt crisis will not fade away with the completion of the Greece debt swap deal, but the focus was shifting to global growth and monetary policy. The data on Friday showing a solid growth in the U.S. employment suggested the world's largest economy was strengthening and in less need for further monetary stimulus from the Fed. As mentioned earlier, the Fed is holding its policy meeting on the coming Thursday this week. Economic conditions elsewhere were less rosy or clear-cut. The China's trade balance data over the weekend showed the largest deficit in at least a decade, following recent reports that inflation cooled in February, while retail sales and industrial output fell below forecast. Aside from healthy demand for industrial metals, assessment of recent Chinese data is mixed, and more figures are needed basically to clarify the uncertainty. The market lacks fundamentals today, and this might signal some further consolidation following last Friday's sharp movements. As mentioned, quite poor calendar today. Most of the indicators due today already being released. Japanese core machinery orders came at much better than expected, 3.4% compared to 1.9 forecast for today, and minus 7.1% of the previous month release. While Japanese household confidence dropped slightly to 39.5 compared to 40.00 the previous month release, and the 40.8 forecast for today. The German wholesale price index monthly release is the only one actually indicator due from the Eurozone this Monday. Came slightly below from the forecast of 1.1. Today's release is 1.0, and the 1.2% is the previous release. We're going to take a quick look on the markets and see the technicals for today. However, before this, I would like just to comment also that some comments from the Kuwaiti oil minister regarding current oil prices, saying that the prices are not justified, adding that Gulf states' current production rate will not affect its level of strategic reserves. The fears of possible supply disruptions from Iran and political tensions across the Middle East have helped to drive up oil price of the both benchmark Brent and the NYMEX crude oil to their highs. Under the supply and demand theory, oil prices today are not justified. The oil minister said in his TV interview. The many producers basically fear high oil prices could damage demand by crimping growth in consuming countries. Brent crude prices shot to an all-time high in dollars of over $147 a barrel shortly before the global financial crisis of 2008, while also the NYMEX crude oil at the same time hit its highest levels in history at 147.85. This was in July 2008. Now, as said, we're going to take a look on the technicals and see the latest movements of the majors and the commodities. Starting with euro, as we can see, the euro is in the downtrend of 132.90 last Thursday's high. The losses accelerated after a release of a better than expected US jobs data, and the immediate result was a brief break below our initial support at 131.00. This is the higher platform of 6th and 7th March 2012. With the low so far seen at 130.77. The current corrective consolidative action on oversold and quite extended the hourly studies sees immediate resistance at 131.23, which is the overnight's high. There is also the 20 days exponential moving average. This is our initial barrier ahead of 55 days moving average at currently at 131.58, and basically this zone is expected to cap the upside for now, as negative structure keeps the downside on the hourly and 4-hour charts, keeps the downside still favored. Loss of overnights low at 130.77 to open the next significant supports at 130.26, the lows of 1st and 6th February 2012, ahead of 130.00 round figure support, and actually the key support of the short term 129.73, low of 16th of February 2012. That is currently in the short-term focus. Only break above 132 would avert the immediate downside risk, while clearance of 132.90, 133 zone, where is also the channel resistance, would signal stronger recovery of the pair and open levels at 133.55, 134 for possible extension towards 134.85, double top of 29th and 24th of February seen on a break. For now, the downside remains favored as long as levels at 131.23 and 131.60 stay intact. The cable is also in the sharp downtrend of 158.30 last week's top, where the market faced a very strong resistance and failed to break higher, triggering a immediate reversal that accelerated losses last Friday after US jobs data, losing 157.20 and 157.00 initial supports, and briefly testing our key support of the short term at 156.50. This is the higher platform lows of 14th of February, 16th of February, 22nd and 23rd of February, and basically break below this level could trigger more significant losses, and will signal also the break below the 1 month range that started at the beginning of February, where the pair was well supported on the downside, but upside remained intact, excluding the false break above 200 days moving average, about 129 zone. Current attack at 55 and 90 days moving average on the daily chart, which are standing approximately at the same level of the higher platform at 156.50, would further weaken the larger pictures structure and the open way for a stronger losses. Immediate targets on the downside: 50% retracement at 156.12, retracement of the broader uptrend from 152.33 up to 159.91. 156.00 as a round figure support, and more significant Fibonacci 61.8% at 155.23. To avert immediate downside risk, we need to see a gain of minimum 158.30 previous high, above which comes the most significant dynamic resistance, 200 days moving average, currently standing at 158.78. Dollar yen holds its positive structure despite current corrective pullback seen on the overbought hourly studies, as last Friday's strong rally when the dollar was pushed by very positive US jobs data finally broke above the previous highs at 81.60, 81.85, surging through next barriers at 82.00 and 82.20. To hit fresh 10-month high at 82.63 so far. The upside remains in focus on the in the short term, as studies on the daily and weekly are into positive territory, although some overextended conditions seen on the daily studies, yet no firm signal of any stronger reversal. On the weekly chart, we can see that next target is at 82.97, the 38.2 Fibonacci retracement of the broader downtrend from 2010 high at 94.97 down to all-time low of dollar yen at 75.56. That would be the next upside the targets. On the downside, so far during the night, the losses were contained just above 82.00. Previous high now reverted to support, with further easing and not ruled out at this point, as hourly studies started pointing lower, holding above their midlines, but started pointing lower, and that might encourage bears for further corrective action before the bulls reassert. Next dynamic support 81.90 is the 55 days moving average, ahead of some mild supports at 81. 81.60, 50% retracement, and more significant 81.36, 61.8 Fibonacci retracement of the latest upleg of higher platform low at 80.57 up to 82.63 high of last Friday, and basically only break of 61.8 level at 81.36 would weaken the near-term structure and risk possible reversal towards key short-term support at 80.55 zone, the higher platform, better seen on the 4-hour chart. This is our key support ahead of a next very strong support at 80.00, but for now holding a possible reversal above 81.40.50 would be ideal for resumption of the broader uptrend of dollar yen, as the larger time frame pictures remain firmly bullish and keep the upside favored. Dollar Swiss extended its recovery after finding a good support at 90.70 during the last week, basically on Thursday, with accelerating gains again on US data and clearance of the previous high and the stronger resistance at 92.00, testing levels above this level so far. 92.17 high was seen until now. Current consolidation correction is still holding around the 92 zone and just above 91.86 20 days exponential moving average. That is seen as a strong and good support for now. A break above 92.0017 overnight's high. Looks for test of 92.50 previous high of previous range ceiling of the dollar Swiss, and the more significant 93.00 high of 16th of February 2012, and also it's lower the base of Ichimoku daily Ichimoku cloud that also acts as a resistance. So if we see the break above 93.00, then we will be talking about more stronger recovery and a possible attempt towards previous highs at the 95 zone. On the downside, as mentioned, immediate support is at 91.86, the 20 days moving average, ahead of next dynamic support at 91.60, which marks 55 days exponential moving average, while only loss of Fibonacci level 91.26, 61.8% would dampen the current bullish structure, short-term bullish structure of 90.70, and possibly refocus the same level for retest. The gold again is losing traction on the overnight action after posting strong rally last Friday, extending gains to 17.16 so far, though still not enough because our next strong resistance is at 50% retracement and previous high at 17.25. Basically 55 days moving average on 4-hour chart held this latest rally as brief break higher, did not manage to sustain gains. However, from the downside, 17.00 now acting as support, psychological support, and the previous highs and lows that is changing its role according to the market movements. Also, it's 20 days exponential moving average on the 4-hour chart, holding above this level. Immediate reversal above this level would keep immediate bullish structure of 1663 low of 6th of March and the higher low of 1677 last Friday in play. However, a break above 1725 is required to improve the structure, while break above 61.8 Fibonacci retracement at 1742 to possibly refocus previous high at 1790. The 4-hour studies are improving and showing strength and showing actually room for a further extension higher, while daily 1-hour studies started pointing lower, however holding still above their midlines and keeping the positive structure on the strong bounce from last Friday's low at 1677 in play. As said, 1725 high needs to be regained in order to open way for a stronger recovery of the yellow metal, while only loss of higher low at 1677 would refocus 1663 and turn the outlook negative. Crude oil April NYMEX contract is still in the positive mode of last week's low at 104.34 posted last Wednesday, with the latest high seen at 108.18 as the pair managed to break above the previous highs. Congestion at 107.20-30 zone. This keeps now a positive tone in play as the current reversal is still holding above 55 days exponential moving average, and this might keep the positive tone in play for retest of 108.18 previous high of last Friday for possible extension towards 109, and the test of peaks at 109.92 and 110.53 seen end of February, beginning of March. Only loss of 106.50, which is 55 days moving average, and the lows at 106, 105.86 would possibly refocus levels at 104.34 for retest. I wish you a nice day.